Hey guys, so we're gonna start today's video basically going over the essentials to trade with me. I'm gonna go over everything you really need to know if you want to be watching my live streams and trade alongside with me and understand what I'm looking at and how I trade. And these are gonna be the main topics here. So the first topics: order blocks, breakers and unicorns, inversions, BPR, draw liquidity, time frame alignment to get your bias, entry, stop, and risk. And basically, the main three things I look at when I take trades is draw liquidity. This the first one, time frame alignment, and then entries. As long as all three things align with me, then I'll get a setup. But if you're only focused on just let's say entry, then you're just kind of pattern trading. You need a setup, a trading model where you have narrative and logic, and that's where number one and number two comes in. The extra part would be price delivery. So if we can zoom in, this is more like I feel like more advanced type of topic, which I'll cover in another video. Something I would explain how price delivery is. Is it consolidating? Is it choppy? Is it seek and short? Is it range bound? Is it expanding? Knowing that, you can really anticipate where price would be depending on your trading model here. So we're gonna get started with breakers and unicorn here. So we're just going to dive in briefly on order blocks. This is an example of a visual I've made. We just see price move higher, retrace, and then sweep, and then get a candle closure under. We have order block. So what I see here is two up close candles. The next set of candles here, we get closure through these up close candles. What I show here would be a bullish order block, and the next time it retraces back inside, I'm looking for price to retrace and respect for lower. Vice versa for the bearish order block, we see these two down close candles. Once we get a candle closure above, if price retraces back into that order block, I'm looking for that to hold for a move higher. So this is what it will look like for a continuation. We go down, move up, retrace back into that order block for a move higher. Then we form a new order block, and if we retrace back into it, we look for a move higher. And this is a chart where I combine order blocks with fair value gaps next together just to show a very bullish continuation here. So now that we already dove into order blocks, I'm going to just dive straight into breakers here. So same thing we have here with the continuation. Let's say, what if we want to remove this candle here? Instead of moving down like we did, so instead of moving down for higher, what if this candle, we're going to remove these two candles. Instead, while we're going down on this candle, so what if we, instead of looking for a move higher, and we're looking at this order block still, it just keeps on going down. It doesn't have to go for a small retrace, but I'm just drawing it for more visual. Let's just say it just goes down through it and get a closure here. What we have is this bearish order block for a move higher being failed, and that would thus be turned into a breaker. So we're going to look for, it does come back inside this bearish breaker. These two down close candle now. So if I draw them out here, this previous order block here, we're going to look at the down close as a breaker now. So if the price does come back in, we're going to look for this to respect for lower. And that's what a breaker is. So if I were to draw what a breaker is, let's say we have a low, we have a high, and then we get a sweep of this low, or get a strong displacement, whatever it is. I prefer a sweep usually because I want to see this as manipulation. So ABC, low, high, lower low, and then we just need a strong displacement through this previous high here. That would give us a breaker, a bullish breaker. So if the price doesn't come back down, we're looking for a move higher. So I'm going to give you some examples of some breakers here. I'm going to show you how the three types of ways how I mark my breakers. Same thing here, low, high, sweep that low, and then strong displacement. When we get a series of up close candles here, I'm going to mark this as consecutive candles. And how I do mark this breaker is I use the open all the way up to the wick high. This works for the most part unless the wick high is greater than the the bodies of the series of candles, then I would just ignore the wick high and just look at the bodies. But for the most part, open all the way to wick high. That's for the breaker, for bullish breaker. Vice versa, if it was the bearish breaker, let's say this is the series of down close candle that we're looking at, look at the open of the bearish candle all the way down to the wick low. That's how I mark it, and that's how I learned through experience and backtesting, where that shows the most consistency. That's for consecutive candles. If we go last candles here, same thing here. What we do is look at the last up close candle for bullish breakers, and what we are looking for is we only want a retracement to focus on this up close candle as our main retracement and a price like higher to support. We don't want this to really run down even lower to test out the other two up close candles. And there will be examples of why we would use last candles over the consecutive. But that's how another example that I would also use. Usually on the higher time frame, this works phenomenally. And then the unique candles, if we just have one little displacement, we're just going to mark the whole thing. That includes the bodies and the wick. There's a soul candle that's just a unique candle there. Hey everyone, quick heads up for all my fellow prop traders. If you want to maximize your deals at top future prop firms, use Go Smart when you make any prop purchases. You not only get the best deals, but an extra 5% rebate on all your purchases. Our platform gives a third of the commission we earn straight to you, and it's all about putting more money in your pockets. I want to show you just a template of what a regular basically setup would be like, and just go over what I see as an order block versus a breaker here. So you just see, I'm just going to move forward like this. You see a up close candle followed by down close, just a little choppy, 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 and you get a series of up close candles here. That is going to be the formation of an order block once we get a closure through these series of up close candles now. So if price do try to retrace back inside the series of up close candles here, which is a bullish order block now, we want to see essentially price reject from it. But if it doesn't, that's what we're going to show here. This series of up close candle, which is a bullish order block, gets violated and becomes a bullish breaker now. And just an example of how I marked it, which is open all the way to wick high. This is a perfect example of a unicorn with a breaker with a fair value gap, which I'm going to go over more in depth once we go to the next topic, which is inversion and BPR. I'll have to revisit breakers in a second because we need to talk about inversion plus BPRs now. Starting with fair value gaps. What is a fair value gap? We have 3 candles here. The starting candle, we have a displacement candle, and a third candle. The gap in between these wicks is a fair value gap. So candle 1, candle 2, candle 3. We're looking at candle 1 wick high versus candle 3 wick low. That's a gap here. And gaps tend to be rebalanced. So if price does come back down, you want to see this fair value gap respect and move higher, rebalance for a continuation higher if that's what it chooses to do for its bias here. What happens if a gap doesn't respect? We get an inversion now, and or other known as IFVG. We'll get a displacement through the fair value gap, and that bullish fair value gap here above actually now becomes a bearish inversion. That's how I treat it as. And now if it does come back inside, we're going to look for this to respect for lower. And the combination between fair value gaps and inversion, if we have multiple gaps here, we're going to treat this as a BPR, a balanced price range. So we're going to zoom in a little bit here. Same thing, bullish fair value gap marked here. We want to see retracement inside this bullish fair value gap for respect high. It doesn't do that. That becomes a bearish inversion. So we're looking for lower while we're also invalidating this fair value gap, which is the bullish fair value gap becoming a bearish inversion. We also leave displacement for a bearish fair value gap here. So I just want to mark it here. The blue box is the inversion. The red box is the bearish fair value gap, and the BPR is the bodies that overlaps it. So that's the BPR. BPR is basically 2 or more PD rays respecting. So instead of just a simple, oh, we have a PD ray here, we want to see it move respect for higher if we do retrace, or if we invert this, If it comes back higher, we want to see it respect for lower. We have two PD rays now. We have the bearish inversion as well as the bearish fair value gap. If price do come back inside this BPR, this is a very powerful PD ray, which I would like for it to really hold out in combination with any other models like the breaker, which I'll show here, unicorn with the BPR here. This becomes very, very powerful. We have the breaker pattern, which we discuss here, and the inversion, which we get a candle closure through the bearish fair value gap, followed by a displacement through to form the bit to validate this breaker. We also get a fair value gap, a bullish fair value gap too. So in that box here, that's that inversion, and then here we have the bullish fair value gap. The combination overlapping between those two is the BPR, and you can really frame the setup with the breaker. And this is what you have. This is basically my A+ setup. If you're looking for an entry model and your narrative with basically your bias, time frame alignment, as well as draw liquidity aligns, this is a very powerful entry setup here. So now we went over fair value gaps, we went over Orderblocks. Just a little thing that I'll just kind of mention here would be two things: consequent encroachment and mean threshold. For gaps, the consequent encroachment, like say for fair value gap, the midpoint of it, the 0.5, would be the consequent encroachment. While the blue here, if we're looking for the bodies, because that's how I look at the order blocks, the midpoint of the order block would also be the mean threshold. So for gaps, consequent encroachment. For mean threshold, for order blocks, the midpoint is the mean threshold. That's the terminology I use for streams and for my trading. This is going to just be to help you really know what I'm trying to talk about. Just to elaborate further, what matters for consequent encroachment, the midpoint, I really use it more for higher time frame. Let's say this is a daily fair value gap. I don't want price to really close through the midpoint. If it's a bullish fair value gap and price do come back down, I would like it for it to wick through if it wants to, and then close back inside. That makes a healthy fair value gap holding the consequent encroachment. Likewise for order blocks here, this could be used for any time frame, really. Even the low time frame, I would like it probably more than at least the 1 minute would be too quick. At least 5 minute above. If we have an order block, a series of close candles, this is the order block here. If price do return back in, we can wick through it and it close back in. More likely, just not even wick through, just basically try to respect anything at the midpoint and above. A quick drill in for higher. That's the difference between consequent encroachment and mean threshold, and that's how I use it really. So back to this tab here, I'm just basically copy and pasting everything and putting as a section of its own. We went over the fair value gaps, inversion, BPR, as well as back here with the breakers. Now let's just combine them here. Something we already talked about here: inversion in red, fair value gap in yellow. The overlapping gaps between them would be the BPR. So red is inversion, yellow is the fair value gap. We have a inversion that was previously a bearish fair value gap here, but once this got inverted, that's now a bullish inversion. We have a bullish fair value gap. The overlapping between these two is that BPR, and you can see how price returns. Like it did wick down a little bit, but closed within. That's a very powerful PD ray for BPR. If you line it up with the breaker here, with the same format with the BPR, the breaker, the stop hunt here, you have a very strong setup here. So let's move on to the next tab now, draw liquidity. This is very easy to explain, but somewhat neglected, I feel like, for most traders. I'm just going to go over all the type of liquidity that I really look at. First thing will be external. That's more for higher time frame, especially on the daily chart. And then we have internal here. Internal more for lower time frame. It could be the 1, it could be the 5, it could be the 15. Just more the lower time frames or the intraday. And then we could have session highs and lows, let's say. Session liquidity. Example of that would be, let's say, Asia highs or lows. We could also go for London highs or lows. That's an example of that. That's more of a, if you're looking at multiple sessions, this is very key too. If you're trading New York AM and we have London highs or lows not taken, that could be the draw in your setup here. Next liquidity would be something that would be more of an immediate draw, which I would kind of separate from the overall liquidity, draw liquidity essentially. I'll just go over, let's say, if we have relative highs, relative or smooth, I think they call them, people call them both, but I do like to call them more relative. If we have equal highs on the lower time frame, that's gonna be my draw. If I'm just if I'm a scalper, I'll be targeting these relative highs or lows. Next thing would be unmitigated gaps. So this could be more seen as internal because example of this would be that I like to use is a 15-minute gap, a 15-minute fair value gap here. And when the gap is, there's no fill back in, that becomes unmitigated. And if I'm looking for price to come back in to do two things usually when we have a unmitigated fair value gap, we either rebalance for more continuation or we just really flip it. For either case, really, you're still looking for that immediate draw for price to run into that unmitigated gap. And for me, since I'm a 1 minute kind of trader, the 15-minute gap, 15-minute unmitigated gap is pretty much of a core case for me. That's all the liquidity that I really focus on: external, internal, session liquidities, and for immediate draws be relative smooth and unmitigated gaps. I'll show more examples more when I try to frame everything together, but that's it for this section here. We move on forward to time frame alignment here. Okay, time frame alignment here. Time frame alignment is something that I do more loosely. What a lot of traders would go for, let's say they trade in the 1 minute, they look at the 15-minute, or let's say the intraday, that's what I call it, and the 4 hour as the high time frame. So I'll try to do this as like low time frame to I call them intraday for me, which is like the middle between low time and high time frame, and you have high time frame. And for the 5-minute traders, a lot of people really go for 5-minute to 1 hour to daily, which is good. I also use very similar too, especially the top part since I'm a 1-minute trader. For the most part, if we look at an example, we look at the high time frame to find our narrative. Then we wait. I'm gonna go based off the 1, 15, and 4 hour here because that works for me for the most part. We use the 4 hour as a high time frame bias, and then we wait for that 15-minute here to either do two things. We align with the high time frame. Let's say the high time frame is bullish. We want to see the 15-minute flip bullish as well, and that just means any 1 minute setup that we can get, as long as it aligns with the bias, we have an edge now. And that's what time frame alignment part of this 3-step model is. That's also a important part because if we have high time frame bullish, we have the intradays bullish, and then we also have a logic and narrative that really aligns with time frames here. If we can have a 1 minute entry model, let's say a breaker here, which we went over already, that gives us a controlled max risk where we're going to put a nice stop on. We have a draw liquidity along with this bias time frame alignment that shows the same direction as the high time frame and intraday. That makes this a very A+ setup. Essentially, we have everything checked, and we can frame that setup all together now. But back to going away from the traditional. This is the traditional route. I like to mix them more loosely. So it could be, for example, the high time frame could be the 4 hour and dailies mixed together. The intraday, 15-minute, and the hourly can mix together. So hey, I'm trying to trade the 1 minute here, right? I see nothing on the 15-minute. I could just drop down to the 5-minute, and example would be if the 5-minute is just continuous bearish, the high time frame, either one is already bearish. We inverse a 5-minute fair value gap. I'm just gonna drop down to the 1 to align with this 5-minute here because there's nothing showing the 15-minute. So I'll drop down the 1 and then look for confirmation for an entry model. So there's gonna be more examples on that. I think it sounds confusing, but this is the traditional route. I just go for more loose route, the loose way of kind of framing my bias here. So I'm gonna show you how I set up all my charting for Tradingview. You can see in the top left here, I have a lot of tabs, 1, 2, 3, 4, 5, 6, 7. That is for a reason that I just choose to do for myself. I have all the time frame listed. So what I do have set up right now, this is the weekly chart for NQ and ES, NQ on the right, ES on the left. I have this linked together with the daily chart. So you can see here, I have these templates. So if I just draw a box here, I create all these templates. Let's say I do for the daily here. The daily will only show visibility on the daily itself. Meanwhile, on the weekly chart, if I draw a weekly, let's say a weekly fair value gap, it will not show on the daily because what you can do is control the visibility where it only shows on the weekly, and you can save this as a template. Let's say I do want to save this and I want to create this as a weekly gap here. You can save that as a template and then have a list of them. Oh, this is where you actually do it. So you would do something like that. And I have this tied together for all my charting. So I'm going to just go over how I have it set up personally for me. Weekly and daily are connected together. I have the 4-hour as a standalone. That's why it's the high time frame NQ. And also another thing is you can also create these little templates for layouts here. And I have quite a handful. So daily, weekly connected, and then I have the high time frame as a standalone. Then this is my main set here. NQ and ES, that's going to be tied to everything else. The hourly, the 15-minute, and the 1-minute. That's all connected together. And I use the 5-minute as also another standalone. Why I do that is because I just really like how the 5-minute really looks like. And it helps me, I'm just going to do all my drawings. It helps me really visualize where price action is going based off all the sessions. So 5 minutes is the only one where I have the session indicators, which I would also link all of my indicators in the description as well, along with all the templates I have. So 5-minute really does help me because it shows the Asia, London, and then green is New York AM, purple is New York PM. So this is what it looks like here. This is how I have my settings as well. And I just look at this kind of very frequently to see where prices looking to go. And I don't like having indicators really swamp all of my charts. So that's why I have it standalone on the 5-minute. Because 5-minute is just good enough for me, for a intraday scalper, to visualize what his price is doing here, split amongst all the sessions. So back to what I was saying here. This is the 1-minute chart. NQ on the right, ES on the left again. If I draw a 1-minute fair value gap here, is not going to show on the 15 nor the hourly. If I draw an hourly fair value gap, I have it set where it's only showing the hourly, even though this is the same template here, the same layout, is not going to be shown on the hourly here, nor the 1-minute here. But if I draw something in the 15-minute, this is what I really liked having the setup. If I draw something in the 15-minute, let's say I want to make it very big so it's parent, I have it set where it's going to show in the 1-minute, but nowhere else. So if I look into the hourly, it's not going to be there. If I look at the 15-minute, that's where I marked it. If I look at the 1-minute, that's where I marked it as well. So I mark it on the 15-minute. Let's say I'm going to delete this and draw another one here. Put it as a 15-minute fair value gap. The visibility, once again, would show on the 1 as well as the 15-minute chart. And that's what you can see here. So doing that allows me to really navigate and clear what I'm looking for. So you can see, like, I'm trading the 1-minute on this chart here. The 15-minute does help a lot for me see where price is going, and I have it color coded so it shows you the pink box is 15-minute for me, and the gray box is 1-minute. The purple is an hourly. The green is a 4-hour, and it goes on from there daily here. And part of the time frame alignment I like to use is essentially going through all the time frames and basically seeing where price is heading. So I just dropped down from basically top to down we have the weekly chart here. This is March 29th, 2025. I see this large weekly fair value gap. I like price to basically fill this gap here. Doesn't have to fill all the way, but just it drill in and then it move lower. Our draw looking like we're gonna try to take out the sell side liquidity. So when we get a fill in here and move back up, I'm pretty bullish for the weekly here. Try to get a drive in into this weekly fair value gap because it's unmitigated before this candle here. If I mark it like that, let's say the next candle, I'm looking for this to move higher here into that weekly. And if I can understand that once we get a drive higher, and if we do flip down, I like this for a move back to sell side here, which is basically already looking forward to returning to. Then I drop down to the daily here. I'm just gonna try to show everything on NQ and not get confused on ES. We have a daily fair value gap with a new weekly open gap because it just basically gapped up. So that's also our draw for lower. And for this week, basically, if we do get a flip here, I'm just looking for this to draw lower. So that makes me weekly, daily bearish, look for a return lower. I just keep on doing top-down analysis here. We have a 4-hour fair value gap, which we did inverse this gap here and retrace back in for lower, 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 take out this low, and we're just basically taking all this outside liquidity. I go inside the hourly here. It's very, very similar here. We get a drill back inside this hourly fair value gap for a leg lower. So it does really help me to align everything together. And for instance, if you want to use time frame alignment for your bias, let's say you execute off the 5-minute or even the 1, whatever it is. If you have an hourly fair value gap and it's been respecting, it has no confirmation for upside whatsoever. We retrace inside this hourly fair value gap at 2 p.m. here, and we're expecting lower still. Until we really inverse this, I don't think this moves higher. We actually move lower because we've been bearish bias all day and all week. We look at the weekly, we look at the daily, we look at the 4-hour, just kind of dropping every down. Everything's staying lower. So how I really frame the setup with time frame alignment, we just dropped it a 5-minute, let's say, and you'll definitely see something here. I delete all my drawings, so I'll have to mark it in, but I think this is what I remember here. Remember how I said 2 p.m. here? Retrace inside of this hourly here. Let's see what happened after 2 p.m. We retrace inside and then rejected off this breaker for a move lower. That's just time frame alignment. Everything's bearish, and you're just looking at lower time frame, whether it's the 5-minute for execution or 1 minute. Everything has just been saying for lower, and I just have all that framed up. Alongside gaps, I also have liquidity too, where so alongside gaps, I have lines where it's also separated by time frames. So let's say I just mark this line out. I have a sell side liquidity and buy side liquidity. If I do mark them, the way I do mark the others are, let's say for SMT, there's for low time frame and for higher time frame. If I put low time frame, the visibility is gonna be different here. It's gonna be only from the 1 to 14-minute time frame. But let's say I do the line for SMT on the higher time frame. What would that look like? That would be shown only in the 15-minute and above here, 15-minute and hourly. And it's a really cool way to really just get things what you want to set up as. Let's say I want to do some lower liquidity. Let's say I just want to mark this out. I don't want to show this on the higher time frame, right? Because it would be stupid. So if I just mark this as lower liquidity here, or trendline liquidity, whatever you want to call it, just imagine if it's shown the hourly here. It's gonna be very, very annoying. I don't want to see that. I only see that on the 1 minute because that's like based off that time frame. So that's why I have it set up there. And we can look at other things I have set too. Let's see. Just keep on going through each one here. Yeah, like a 3 drive. That's also another one. Consequent encroachment wick. If I just do like something for like the 1 minute, that shouldn't be even shown anywhere above that 1 minute time frame. And I have order block for low time frame and high time frame. I'm just separating the two here. One of the most annoying thing that I've basically overcame by doing the setup. Let's say I have just like, I'm just tape reading on the 1 minute, and I just set equal highs. Just imagine this is equal highs here. There would be no reason why a 1 minute equal high would be shown on any higher time frame above the 1 minute. Imagine showing the 1 hour. This is a perfect good example of why I just really appreciate this style here. This just means nothing on the hourly. It only means something on the 1 minute. So that's why it just works out phenomenally for me. I've been using this setup for years now, and I think it's just been helping me because I can look at every single time frame here, just flipping through them, and I have a system to this madness here. So I think a lot of people have been requesting how I set up my charts. I'll link a template for all these layouts here, where you could copy it if you like, and as well as all the indicators. If you're like looking for like, oh, what is this indicator for session indicators and what the settings are, I'll have that also in the description. So I'm gonna now go through my templates that I posted on Twitter, and then we're gonna use this as example. I'm gonna go through each one of them first. So I think we already showed here the unicorn BPR, right? We got the breaker, we have the BPR, we have the stop hunt. I just use this as more of an OT type of thing. A rule of thumb for me, for the most part, it doesn't have to follow this case, but if you're looking for longs, you want to look for discount, and if you're looking for shorts, look for the premium. That allows you to really control your risks. So more going into this BPR, we already talked about this inversion, fair value gap, overlapping between them is a BPR. Through a lot of these examples, once again, another unicorn here. We have a high, we have a low, we have a higher high here, and then eventually we got displacement through this low. We have a BPR in between these gaps, one retap back inside for a leg lower, and you can see that here. That I try to draw the same exact format, but without the consolidation and all the choppiness. This would be the same format here. We have the breaker, BPR, retrace back inside. I put my stop above the high. Why I do that, not above the breaker, is because if you do it above the breaker, it can wick you. And it's a very tiny, tiny breaker here. So let's say our entry was 888 here. The breaker just extends like 4 or 5 points higher. It makes more sense to just put it above the swing high. That's why it does vary in how I trade the breakers and the unicorns here, where I put the stop. If it's more reasonable, where I can allow myself for price to not get above the breaker, then I'll do it there. But if I think it's too tight, I'll just put it at the next swing high or the next internal high, essentially. Lots more examples here. I'm just going to move on to the next one because we know the deal with unicorns, with BPRs now. We're going to move on to types of breakers and how I mark them here. So continuation candles. Let's just look at this here. What do I see? What did I mark here? I think I did bearish continuation candles, right? So we have this series of down close candles. We actually wicked higher, but I'm going to use that wick low still because I'm looking at the whole swing low. I'm not looking at whether it closed bullish or bearish. We're looking at open of the first bearish candle here, all the way down to wick low. That's an example of a continuation here. This is an example of a last close candle, and why this works. Usually used better on higher time frames, but this is an example on I think the lower time frame. We have a 1 minute here, a 1 minute breaker where we have a series of up close candles, but it would be more advantageous to use this as our last close because we already manipulated. We took this lows, and if price is very bullish, oftentimes you just want a quick retap back inside. And this is already a deep retrace. If you do use the series of close candles here, you're expecting price to actually hold through enough for this internal low. That doesn't make sense to me. If the breaker is there already, we want to see this quick retap in for higher. We don't want this to really slam down through all this. So this is too much wiggle room. That's why the last close candle really worked in this case here. And the unique candle here, this is what happens when we get a stop hunt. we got a price leg higher, and then we actually get another stop hunt here. Strong deep displacement through this low, followed by a quick reversal. The previous price run we have on this before that big drop, we're going to use that as our breaker. So once we tap back inside, we're looking for a move higher. So these are the templates. These are very, very old. This is like a year old already. I definitely refined them to a more of a 2025 type of style. But I'm just trying to just basically take the model itself here, not the examples too much. Inversion with the unicorns. Let's go over this here. This is basically when a unicorn is formed. We often get it when we do a large stop hunt and leave a gap, and oftentimes we can use that to anticipate the breaker forming, or even a preemptive entry if you already kind of feel like the breaker is already going to form. So for this example, let's say this is the high time frame liquidity that we're targeting. We get that stop hunt. We have that gap here. We flip that gap. So we don't have the breaker yet because the breaker confirms on this move higher. But we flip this gap. If you're already thinking you're bullish because let's say the high time frame is bullish, the intraday is bullish, and then we got a quick little sweep, that allows you to actually enter off the inversion. And then once we get the confirmation here, you can actually add back in once the breaker validates. So I definitely explain this in depth here. And you also target, let's say, internal swing high versus relative equal highs. These are more examples. So we've got that flip at 1. And at 2, we have the fair value gap. And 3, we also tap back inside the inversion. Just many wicks and PD rates looking for holding price higher. We have the fair value gap. We have the inversion. We have the breaker. And then we already did a stop on. If we're already bullish on higher time frames and also bouncing back in the high time frame PD array, this is pretty much a ballpark setup here. And I'm just going to go over very, very briefly the example here. Stop hunt, multiple drives here. Likely back inside of high time frame PD array here. We get this flip. This is that inversion here on the first drive. We didn't get the breaker yet, but if you're already somewhat bullish because we have low resistance as well, lots of things aligning for higher prices. This is where we get that candle closure. That is when the breaker validates and retap back inside. We got a fair value gap. That's a unicorn now. So inversion here, breaker validates. Once we get a closure through, unicorn model because it's a breaker with a fair value gap aside and a price higher. Basically every setup, every example is gonna be the same thing here. Yeah, so these are basically the Twitter highlights templates. It's a little outdated, but it still works fundamentally, especially how I draw everything out. How I mark these candles, 3 types, the inversion models, and the BPR unicorn model here. This all works out. The examples are just a little bit outdated though. Okay, so the last part of this whole thing that we already did the Orderblocks Breakers unicorn, inversion, BPR, draw liquidity, time frame alignment. Last thing will be entries. For me, I always say entries can be anything as long as you have the draw liquidity and time frame alignment first. So keep that in mind here. Let me just zoom in. Draw liquidity. That's going to be number 1. For any setup, you want to see what is it drawing to. As well as what are you targeting? Are you looking for just a turtle grab? Or are you looking for the main liquidity to be taken? And then followed by time frame alignment here, which we already discussed about. For the most part, the intraday is the main focus. You want to make sure your intraday aligns with your low time frame. So if the 15-minute is your intraday, if it's bullish, we don't need the 4-hour to be bullish as well. It could be neutral, it could be bearish even, but as long as the 15-minute is bullish, we wait for the 1 minute to flip as well before we take the entry. So that's how you do the time frame alignment. You make sure, rule of thumb is align your intraday with your low time frame. So entries, stops. Where are you entering? Where would you put your stop? For all my trades, I think more than 50% of them are always breakers and unicorns. but I don't necessarily have to take that trade based off it only being a solo because it's a breaker. I could also take it off an inversion, BPR, a combination of all the variety, even like inducement or turtle soup. As long as your draw liquidity and time frame aligns, your entries really doesn't matter. Just whatever gets you there. And just for a rule of thumb, also for breakers, if I trade it on the 1 minute, if it's a 1 minute breaker, it's gonna be 10 to 15 point stop. If for the most part my stop would be under the breaker, which we'll see a lot of examples of. If the breaker is too tight, let's say it's like a 5 point, 10 point breaker, and you put your unicorn entry midpoint of the breaker, you're not gonna do like a 5 point stop. That would be something I would consider doing the next internal high, or low instead of the breaker. And you want to be very careful of how we interact with that. If it's a bearish breaker, you don't want a closure above that breaker because that can invalidate the trade itself. But you also want to give enough wiggle room. So that's why if it's too tight, if the break's too tight, you put it next internal high or low. So let's just go into examples with this. What I like to go more so is real example. So I'm gonna go through this week here. Real examples, trades that I took on stream. This is one here. You can see my entry 827 targeting 897. That's basically this very classic breaker unicorn model here. And target is the buy side liquidity. So I would play the recap at me explaining that. And after that, we're going to move forward to another trade. I'm going to go over the trade that we took on PM session today on stream on YouTube. So today is March 21st. And this is what it looks like. So I want to just go over real quick on what I'm looking at. So from PM session is the purple box. That's when the start of the PM session. 1 p.m. to 3 p.m. is usually when I trade. And what I see here, right from the rip, you see London highs with a New York AM high. We just made an equal high there. You can see that on the 15-minute. And what I wanted for the trade was price to, if it were to reject, to come back down and respect this 15-minute breaker here. While we're also inside this 15-minute fair value gap, which is basically unicorn. I also look at ES2. So we need to retrace the 15-minute here as well, kind of bouncing on this OB. And what I like to look at is I'm anticipating what price is looking for. So for instance, we did move higher here and then move back down. I'm looking for this as support to basically draw for the London high, the AM high, to really take this out. So that's our objective here, that equal high. So I'll drop down to the 1 minute, and this is what I look to anticipate every time on stream, just drawing arrows, what I want to see. And you see price action just moving lower and lower here, and just trying to teasing this low. And I'm also looking at ES just for S&T or what I think price could do. And you see this relative low here kind of being built up. You see, I'm looking for one more drive lower here. And this is going to be a trade that's going to be based off the 15-minute as an entry while looking at 1 minute or low time frame as a confirmation. So I zoom in here. I'm just going to delete this here. At this candle, we tapped inside the 15-minute. That's exactly what I want to see at this candle here. And then we start flipping higher. I want to see anywhere. Do I have a confirmation on lower time frame? On the 1 minute is what we have here. Breaker close, retap in. That could be your entry. I like to look at any fair value gaps that we could turn. So this way, we don't really play, for instance, we don't play for a falling knife. We wait for a flip first, and then that'll be our trade. So I did go on stream here and talk about looking at 30-second. And this is not it. Where is it? Right here. Okay, so 30-second is what I'm looking here. We have a 30-second fair value gap here, which we retrace. We made this low, retrace back down. We wicked that. That's the manipulation. I looked on ES as well as NQ just bouncing inside of this 15-minute unicorn. And the moment we flipped on the 30-second, this is what I've been saying. If we bounce here and we flip, that's going to be my entry, the 30-second inversion. That's why you see my entry at 827. But while we have that inversion, whether you take breakers, inversions, whatever it may be, we also have this breaker here. Low, high, sweep that low, close, and then close right here. Whether you take the inversion as your trade or retap backside the breaker, that's your trade. Why this breaker matters is that dictates your stop. I don't have to put in stop necessarily down the wick low, which would risk more about 25 points. I do with a breaker low. That is kind of within my risk parameter, which is about 10 to 15 points. That's 14.5 points. And remember here, we're going to look for a draw higher because we have relative equal highs at this London high, 3 a.m. high. We teased that high there on this 1 p.m. candle, and I just want this to drive in. And that's exactly the trade we took today from YouTube, and that's how I framed it. Now, I was able to frame this trade pretty much after we reject this high. If we do reject it, I'm going to look at the next support, which is inside this 15-minute breaker, as well as the unicorn. This is basically the entry here. The entry is not the low time frame play. The entry is the 15-minute, but I'm looking at a lower time frame flip here before I take the entry, because why we do that is let's say instead of a shallow wick like this, it could also wick all the way down here, do a splash wick, and then come back up, and that's still going to be respected on the 15-minute. So instead of catching a knife, we wait for that flip, and like I said, it could go something like this, and then instead of getting stopped out, we wait for the flip, and then let's say it does something like this. We take it when we get confirmation on that flip, while inside that 15-minute entry model, and that's how we were able to really take 70 points on stream here while risking only 14.5 points. So now I want to go through another trade that we took basically the same week. Last one was a PM session trade. This one is a Asia session trade. It's the same thing here. It's a breaker model setup, a unicorn, and you can see my entry. This is taken on Discord. This is the entry. I got my entry here. Took my first trim at, I think, 20 points, look like, and then the last one is at 35. I'm just gonna go through what I see. This is like basically my thought process. I send alerts and commentary. So my idea is looking at the 15-minute order block as the next support to hold. And it's going to be better just to see the picture. So this is that order block here, and kind of how I'm framing this, anticipating where price is going. Yeah, so this is what I want to show. Someone asked about the 15-minute, and I just had explanation framing it. So this is perfect for this case, so I don't have to cherry pick this. 15-minute order block here. We have a buy side. We're teasing the high there. We retrace back inside of it. I don't want a if I look at the order block, we use the whole candle with the bodies. Let's say we just use the whole bodies here. It would be from this low to this high. We don't want a closure at the midpoint of it. That's the mean threshold. So it can wick under and close back above. That's a bullish signature here. And while we're doing that, you can see we retap inside, we close, and we're coming back up. We have a 15-minute fair value gap now, which we actually inverse and propel higher, which I also included in my analysis. So if we drop down to the 1 minute now, you saw the 15-minute order block, we actually bounce. I'll try to describe this best I can. We have a 1 minute breaker here, and we sent this up. We just chopped around a little bit. We actually had a very low time frame bearish breaker to send it down to this internal low. So basically to rebalance inside this 15-minute order block here, which is also 1 minute breaker. And then we actually flip this back up to another breaker. So it's like we're just back and forth. We bullish breaker up, bearish breaker down, hold on this 15-minute intraday time frame bias, and then we actually sent this up with a 1 minute breaker here, which actually held. We took the entry and then we played it all the way up to this high, which I could have easily held for more. But Asia trade, this is it looks fast, but this is actually more of like an hour-long trade here. And that's gonna basically do a recap of me framing all the setups, everything that we learned together. So we're trying to piece everything together here. The trading model, the draw liquidity, time frame alignment, and the entry. All these three. Price delivery is something I'm going to explore in another video because it does add to it. We went through basically entry ideas and looking at how we use it as validation and invalidation with draw liquidity, time frame alignment, and your entry, stop, and risk. We combine them all together, and that makes our trading model here. So hopefully that is something that would help you guys trade alongside with me. It's basically the raw essential. That's be the first part. Comment below if what else you want me to dive into. I think this price delivery is the next part. We can look at more examples, more live examples. as well as just more advanced theories. This is basically a beginner's touch here. So if you guys want more, let me know in the comments. That's going to wrap this up, guys. See ya.